Well, good evening, everyone, and welcome to the PayFred program. And this year, we're doing a special program on the 2025 taxes and loan repayment deadlines that are coming up. And this is due to the big, beautiful bill. Let's get going here. This year's taxes are absolutely critical going forward. With the IRS integration becoming more and more of a part of the loan repayment process and the shutdown of the legacy systems in the middle of the year, again, having the taxes done the right way, and we haven't had income recertifications for the IDR methods since COVID. So again, this is a big deal for everybody. So let's get going. So today's agenda is basically, a review of who PayFred is. I think most of you know who we are. Understanding the new repayment rules and the IRS data integration. That's why this year's repayment methods are so important, your decision making, because if you're not aware on the FAFSA side, that integration and mandatory IRS data use is already there and existed for the last 2 or 3 years. So that is coming on the repayment side. Proper positioning for the upcoming big, beautiful bill deadline, and then who needs to take action. And then if there's any questions, be happy to answer those. So the common slide here, PayFred, here's our partners, here's who we've peered in. Again, a comprehensive approach, and I think that's what makes us really different. Most of the industry is either college funding and student loan repayment. In the new world, you basically have to have college funding, student loan repayment, tax strategies, which include savings plan options, how do we structure the debt the best way. That's going to be the new important part. We have a separate program going to be coming with that. This year's college decisions, this class will be the first class to face those new federal loan limits in the big, beautiful bill. Again, we bring the personal taxes, personal financial guidelines and tax information together with the financial aid process. Again, with the increased use of the different laws that are happening and changes, this is becoming a major part of most people's financial plan. It's the largest purchase we make on our own, and it's the largest most families will make before retirement, and people are having their children later in life. As I said, I have the most amount of approved CFP courses covering these topics. This is our approach. We can answer any questions that you have and provide answers, customized answers to you wherever you are on this path. It's not, we have to outsource this. So we can give you an answer wherever you are. We have software for advisors, training programs for advisors. There's consulting services that you can come directly to us or through an advisor. And we also have an employer solution, which is be upcoming in the next year or so. So these are the things we've already provided here. Again, we've had today's presentation is the series, our virtual financial aid series. Our next one is on 318, which is understanding the award letter. And that will be critical for this class as they will face the first news of the new limits on the big, beautiful bill. So that, again, is really important. Just as a disclaimer here, PayFred is not a financial planning firm, an investment firm, or tax planning firm. Any of the financial products, ideas, or tax strategies discussed here today are not recommendations to purchase or implement. You should consult your financial advisor or tax expert before making any investment decision. Past performance is no guarantee of future performance. So let's explain how the big, beautiful bill is impacting the loan repayment deadlines and how it kind of combines or is needed for the your tax planning scenarios as we approach this. So to qualify for the legacy the legacy repayment methods, you have to be in the right position, both from a tax standpoint and from a repayment standpoint by 6/30. The problem here is that deadline is somewhat misleading. Yes, it has to be done. But in most cases, there'll be other things you'll need to do beforehand to take advantage of that. So as an example, if a parent has Parent Plus loans and their child just graduated or is planning to graduate in May, they may want to forfeit the repayment process, the grace period to qualify, their grace period. If their child graduates in May and now they, would have a 6-month grace period basically, Well, you may forfeit that because you won't be able to qualify for the legacy repayment methods. Again, you're going to have to run your numbers, but these are the type of things that, things will have to happen. So to get that started, you'd actually have to start sometime in March to get the consolidation done, to get the rate repayment done. At the same time, make sure your taxes are filed the right way. Again, these are the things that have to happen, and that deadline is kind of misleading. If people just look at the headlines, they're thinking, oh, I have time. Now, the government's been pretty good in the past to handle when submissions happen, but again, depending on each situation, what you need to do to get to the right position may take longer than what we think. And again, in the past, they've used the postmark, but again, if you need to do a consolidation and the consolidation isn't completed, you can't register for the repayment method. So again, these are things that people have to be aware of. Again, our preference right now is that you are in the right position and you've made one IDR repayment to qualify for the legacy situations. Again, what we're also thinking about with the process, there's a current backlog of IDR recommendations. And if everything is in good positions, again, depending on your situation, if your tax filing position for 2024 is in good position, you can use the automated process. If not, you have to use it's not a paper process, it's a still electronic process, but it's a manual process in the sense that it has to go through people to make the confirmations, where the IRS integration does not. So again, currently we're not mandatory. It's not mandatory that we use the IRS process. It's recommended in most cases, again, if your data is in the right place, but they are checking and using it as a double check. What it will do is increase the verification and simplify the process for many users, that they won't overlook it. Again, a lot of information comes out of the Department of Ed and through the loan servicers. It will eliminate the ongoing recertification process for income-driven repayment, and income-driven repayment now makes up about 62% of people in repayment. So it's a big deal. Many people overlook this. Again, we haven't had income recertification since COVID. So this is another big issue that can really help people. So that from a planning standpoint, when you do this with clients, is that now we can set you up at least going forward. And the only thing you need to worry about is how you file your taxes. So do I file married, joint, married, and separate? How do I maximize my AGI to make my payments the lowest it can be? Again, we're seeing other things with the advantages to having the integration turned on, because if you go past the 6/30/26 deadline and you miss a income recertification, there is no IDR repayment method for Parent Plus loans. So you would lose your legacy option if you should miss that opportunity. That's why it's important that you turn it on at some point in time. Not say you turn it on automatically right now, because right now we're in this tax filing situation where maybe last year's taxes aren't the way it should be. So again, these are things that we need to do. And there's a substantial backlog in this manual process. There's over 700,000 applications at this point in time that need to be processed. They've been working that down, not quickly, but they've been working down, only because there's another 7 million people in the SAVE program that have to make a transition also, because we don't know what that lawsuit final rules are. So understanding right now the process of how the automation works within the IRS, at the time it's a little unclear. Pre-COVID, it was between 4 to 8 weeks before the data was actually available to the Department of Ed. So example would be, I filed my taxes, say, on April 1st. It would take a month to process through and get approved by the IRS to pass it on, and then take another 2 to 4 weeks to get to the Department of Ed where they would actually use it. So it may be there, but it's processing and getting updated into the systems. That was pre-COVID. We have not been able to confirm what it's currently doing. Again, there's been a lot of changes, but I want, some of you may not realize, but under the FAFSA process, that now is automatic. So you have to use that, the prior term. So again, in time, I think by the end of 26, and maybe as this full integration completes, it will become faster. So that's a really important part. Now they will look back. Example, an example that I talked about earlier, if we have a couple that's, have Parent Plus loans, only one has parent plus loans as a parent, and they file married and joint, which most cases are going to be tax efficient. If your 24 taxes are used for the IRS integration, you pick that by accident or whatever, it's going to use the joint income, where if we now file our 2025 taxes married and separate, because it's student loan efficient, not tax efficient, but it's going to overall give you a net lower number, and we'll see that in an example coming up, is you would want to use the manual process because you have to file your taxes the right way, and you don't want to use the electronic version or the integration because it's going to pick up your 24 taxes. So again, these are the things that we have to work through to meet this 6/30 deadline. Unassuming that most people are going to use the most recent filing that's on time, this is where not using that automated process right now will be important. So a big part of this is people that are married, that only one has debt. Again, in some cases, if both have debt and there's a substantial difference either in income or in debt, filing married and separate is typically a benefit. Now, what happens in many cases, and I've had 2 or 3 cases in the last week where the tax preparer came back and said, hey, by filing married and joint, you're going to lose $3,000 of maybe a refund or additional tax in your tax preparation. And they say, well, why would you ever file married and separate? Well, the tax preparers typically do not take the next step and see what that's going to have an impact on your monthly payment. Again, you'll see this in an example. But in all these cases, when we did it and we filed married and separate, yes, they'd have an increased tax burden, but their payments would offset that difference. So again, if we now file married and separate, I'm going to pay $3,000 more in taxes or lose a refund. Yet in total, my loan repayment is going to be $7,000 less. So by the annual looking at it from a total standpoint, that's $4,000 more in your pocket versus if you filed married and joint, which was tax efficient. This is where this is often overlooked, and you'll be able to see that in a second here when we get to that slide that's coming up as an example. Again, in the original proposal from the Big Beautiful Bill, the Senate was opposed to file married and separate. You can file married and separate. It's important to realize that in the IRS rules, you cannot, if you filed married and separate, you can amend the return to married and joint. But if you've maybe by mistake or you listened and found out later that you should have filed married and separate, you cannot amend the return to married and you can't go from married and joint to married and separate. You can go from married and separate to married and joint. So that's an important part to recognize, that is you can maybe amend your return at some point in time. It's important to also understand in your download or understand when your income recertification happens every year. That will impact when you file your taxes. And again, seeing both sides, and this can change year to year. One of the clients that I had another change in the following year. So again, using that 18 or 24 month backlog of when they'll look back, when they file their taxes that next year, they had a big change. They were selling a home, or they're a large capital business they were selling. There was a significant capital gains benefit by filing married and joint. In that case, you can, again, manage the tax timing of when you file your taxes and what will be used, because each year with the income-driven repayment methods, your income is recertified. So let me understand, just to understand how the deadline's coming. Again, about the processing that we're worried about. Many of the thought leaders that I follow and I put my opinion in also are talking about this mid-March, early April deadline to get the processing time. And there's a lot of other factors that are, worrying us. This, what I've already told you, is the 700,000 backlog already. And then we have 7 million possibly that get turned on because of the save return on. So again, this is where this could become very difficult. Now, as in the past, they've been very kind. If it got postmarked or got processed here, that may be, the government will recognize that. The problem you have is there's other things that may have to happen. You may have to have your taxes done the right way. You may have to do the consolidation. all these things may have to happen before you can get your paperwork done in the right order. Again, knowing which situation, how to handle that, that's what we do on the other side. But again, having that, understanding the processing dates and what you need to do to get to that submission form, that will be also really critical. Here's the example that I referenced a few times in the prior slide. So here's a married couple with one borrower. They have Parent Plus loans. And we're talking mostly about Parent Plus loans because, again, if you're a single person and you're not married and you have high debt, it's just going to use your tax information. Now, how you manage your AGI is still important. But when you have a married couple and only one has debt, this is where the complications really get into here. So now we have, the borrower is 59, so it looks like they're going to carry this into the retirement. So this is an important part. And the borrower's AGI is $75,000. And right now, again, they don't have the loans consolidated. And to get access to the income-driven repayment methods with Parent Plus loans, that's the one exception. You need to have direct consolidated loans to qualify. If they take no action, so we missed the 6/30 deadline or we didn't hear about it, their monthly payment under the new methods, okay, because they're not going to qualify for the legacy because that's 6/30, their monthly payment is going to go out 25 years and it's going to be $1,100 a month. So that's going to be a pretty tough bill, as we go into retirement. And there's no option for this Parent Plus loans. As I said, there's no income-driven repayment method after 6/30, after 7/1 of 26. So this was an important part. Now, if they take some action, as an example in this case, they had filed joint. So if we file, one, do the consolidation, and that may take a month or two. In this case, because of this backlog, we would probably select the fixed method to process it, get our taxes done the right way, and do this. Again, we can do this all beforehand, and then get the consolidation completed. This is that lag time. That's going to take maybe 6 weeks to 8 weeks to get done. And now we're going to have to enter into the ICR method, okay? And initially our payment's going to be $909 because of the income. Now, part of this legacy transition, though, everyone will be moving over to one of the IDR methods. And in this case, because of the timing of their Parent Plus loans, their payment would actually go to $730 a month. And as they go into retirement, as that person, retires and their adjusted gross income goes lower, their monthly payment would be much, much less. So again, these are the options that people have to realize or recognize before 6/30 of this year. And there's no loan forgiveness options because you have to have an income-driven repayment method to qualify for loan forgiveness, either the public service loan forgiveness or the IDR end of term forgiveness. So this is the example we can see. And just looking at the numbers here, you can see here, perfect example, tax efficient, there's $1,200. So right here, we're at $900 basically a month difference in payments. So say even if that tax bill was going to cost us $6,000, over the year, you're going to have a savings of $11,000 or $12,000. It would pay still to benefit by filing married and separate because of this monthly payment. So these are the things that we're trying to get out to the people and how important this year, because this is the last year, especially for Parent Plus loans, that we have an IDR methods. In addition, these other methods are here. These legacy options, if you're enrolled will be carried forward, but these are fixed payments, or two of them are. We're not users of the graduated methods, but at least on the other side here, if you did an extended here, this would be $1,000 a month, which is a little bit less than the $1,100, but that would go out 30 years. Again, these are the type of things that we need to be looking at as options as this deadline approaches. So who needs to act right now? Who's the ones we want to focus on? Well, all current borrowers should do some type of review and do some type of tax filing decision, especially if you're a married couple. If there's a single person, they should at least minimize the review because, as I said, there's been no income recertification. We have done, single people, or even single borrowers who they're using 2019 income numbers. So we've seen situations where someone was making payments of like $400, and their new payment, maybe they're a physician or whatever, will go to $2,000 a month. we're seeing those type of things. And this is where, making the right decision, knowing when your recertification date is, when will that happen and how much will it be, is absolutely critical in your tax filing decision. So say you got married during COVID, depending on that person and their debt and what plan they're in, they could also include the other income, and that number could be $3,000 because the spouse gets added into the income-driven repayment method. Again, everything's moving off the IRS data or how you file your taxes going forward. Again, one of the other groups that we're really focused on, as you heard in my conversations, are the Parent Plus loan borrowers, because one, the IDR method goes away. So anybody that's in current repayment or has Parent Plus loans right now needs to be looking at this. Anybody that has graduates at any level that has Parent Plus loans, because you may have not been making payments on them, so you have an undergraduate that's going to graduate in May, you would want to look at them because their disbursement will happen by late January, early February, worst case. You can turn the repayment switch on. You could start doing this work here to get access to the legacy things. If we wait till graduation, we're going to pass the 630 and you take advantage of the grace period, we'll be past the 7/1 deadline. You will only have the new tiered method. So again, that's another problem. Another issue that we see are parents who need access to, IDR methods specifically, that they need to manage that. So we saw in that case where, there was significant amount of debt, that change in payments. We may want to enroll in the IDR method now so that we have lower payments going forward. Again, that's for 25 years, the example we showed you with the Parent Plus loans in the prior slide. Again, there may be a situation where there's future loans needed, where that's where maybe the other parent would take on the debt, the new debt, to finish that child. We've had a few cases where, this is the youngest child. The child's going to qualify for Parent Plus loans going out to finish their next 2 years, but they have debt from the prior children. This is where we have to do some additional planning. Any students that graduate from undergraduate, graduate, postgraduate programs that graduated this year need to make a decision now and get their taxes done. I would even recommend people that in those same cases, if you have, low income, maybe they're just working a summer job, have a minimal amount. Again, the time frame that the government will look back, they can look back 18 or 24 months. If they file their taxes for 25, when they graduate next year, they could use the IDR methods, as a graduate, because they're the student. Parent Plus loans will not have access. They will use that lower income. So again, another reason why you'd want to do that. And anybody that's enrolled in the SAVE program, there's 7 million people currently enrolled in SAVE. They also have to take action. So they're the people that we're most focused on at this point in time that will need help navigating this transition. So what do you need to do as you go through this process? One, log on to studentaid.gov, the website there, get your federal data, look at it. There's a download process, is what we use, is the data there. That will look at, what type of loans you have, the dates of the loans, understanding what options are available to you. It'll help us understand if you need to do a consolidation to get access to that. It may help you consolidate, public service loan forgiveness credits. There's a whole set of things that having that data, again, it's called My Student Data. And many people think that Parent Plus loans are in the child's name. They're in your name. They're legally your responsibility. So just be aware of that. Understanding the income of the borrower. So again, if maybe both parents have loans, typically it goes to one parent. The borrower is who we need to focus on. So how's that AGI looked at? The AGI line that you need is line 11 on the 1040, and line 24 is how much taxes. That's I was talking about, making that comparison, seeing that difference between the 1100 number on the if we file married and joint to the 370, and then we have to see what the tax differentiation is. They should offset each other, making the repayment. Should we file married and joint or married and separate? Just as a point of reference of how you do that, so that you understand. We're saving. It's going to cost us $3,000 more to file married and separate, but we're saving $8,000 in loan repayment a year. So it would make more sense to do it that way. And then also looking at this, considering who to focus on and who will need access to the legacy IDR methods. Again, forfeiting next year's grace period may be a lifesaver for a lower payment over your lifetime. Again, so this is where moving that up, again, if you really look at it processing wise, you're really forfeiting just the grace period because it's going to take us 2 to 3 months to get this processed. And our goal here, the way we set this up, or at least right now at this point in time, until we understand more what the processing backlog looks like and how they convert the people from save, is that we would like to have you in the right repayment method and made at least one payment before the 7/1 deadline or the 6/30 deadline. That's our goal at this point in time. Because of this backlog, we've seen, errors and issues with the loan servicers and the federal government due to the shutdowns, and that's another thing that's out there. All these things are factors in getting the right place. Again, if you have any questions here, please type them in, and hopefully I can answer those. So here again, we're here to help you. We provide answers along all parts of that. We're also concerned with the deadlines here, as you hear me talk about this, but also the new loan limits. This is going to change how parents pay for college. The biggest change here is there's an annual limit, and parents will now be involved with graduate school. So if you have a new student either picking college or headed to grad school, again, doing the right things before 7/1 of 26 will be critical on how and what loan limits they will get depending on their time of enrollment. So again, these are the things that we're looking at. I guess I either have done a really good job or totally confused you. So again, there's no questions that I can see, and we will just let it go. Well, thank you so much for joining us, and have a great day.